Friday of every month, a single number is released by the U.S. Bureau of Labor Statistics that moves financial markets around the world simultaneously. The non-farm payrolls report tells investors how many jobs were added or lost in the U.S. economy in the previous month. It's the most widely anticipated economic data release in the world. In the minutes following its release at 8:30 a.m. Eastern Time, currency markets move sharply. Bond yields adjust, equity futures reprice, commodities react. The reason is direct. The jobs report influences the Federal Reserve's interest rate decisions, which moves everything else. But here is the part most traders get wrong. Reading the jobs report correctly is not about whether the number is big or small. It's about understanding what the number means in context. And that context is almost always misread by those who have not studied how this data works. The non-farm payrolls report measures the number of jobs added or lost across the U.S. economy in the previous calendar month, excluding farm workers, private household employees, and self-employed individuals. The report comes from two separate surveys. The Establishment Survey asks businesses how many employees they have on their payroll. The Household Survey asks individuals about their employment status. The headline payroll number comes from the Establishment Survey. The unemployment rate comes from the Household Survey. These two surveys can tell very different stories in the same month, and understanding why they diverge is itself analytically important. Beyond the headline numbers, the report provides important detail: which sectors are adding or losing jobs, whether workers are working more or fewer hours, and whether average hourly earnings are rising or falling. Average hourly earnings is particularly important because it is a leading indicator of wage-driven inflation. When wages are rising strongly, that tends to support consumer spending and can put upward pressure on prices, both of which matter directly for the Fed's inflation mandate. The jobs report moves markets so dramatically, not because of the number itself, but because of the gap between the actual number and what the market expected. Every month, dozens of economists and financial institutions publish their forecast for the upcoming jobs number. These forecasts get aggregated into a consensus estimate that is widely published before the release. That consensus estimate is already priced into markets before 8:30 a.m. Eastern Time. Here's a concrete example. In November 2021, the U.S. reported 210,000 new jobs. That's a healthy number by historical standards. Markets sold off sharply. Why? Because a consensus estimate had been approximately 550,000. The gap between expectation and reality was so large that a good absolute number was received as a major disappointment. This dynamic, where markets react to the deviation from expectation rather than to the absolute value, applies to virtually every economic data release, not just the jobs report. It's one of the most important and consistently misunderstood mechanics in market behavior. Learning to track consensus estimates before major releases and how to assess the actual number relates to that consensus is one of the most practically useful habits any trader can develop. One feature of the jobs report is that it is almost universally overlooked by new traders. The numbers get revised, sometimes significantly. When the report is first released, it represents a preliminary estimate based on responses available at that time. Following month, the Bureau of Labor Statistics releases a revision incorporating additional survey responses. A second revision follows the month after. These revisions can be substantial. A number that appeared to show strong job creation in the initial release may be revised sharply lower, or vice versa, when more complete data comes across in. These revisions can be substantial. A number that appeared to show strong job creation in the initial release may be revised sharply lower, or vice versa, when more complete data comes in. This means that initial market reactions are sometimes based on numbers that will subsequently look quite different. This is why sophisticated analysts track trends across multiple months rather than reacting dramatically to a single release. The underlying trend in job creation matters more than any individual month's potentially noisy and subject to revision headline. A practical implication: when a jobs number is unexpectedly weak, checking whether the previous month was also revised lower is important. 2 consecutive weak months plus a downward revision is a different signal than 1 weak month with an upward revision to the prior period. Understanding the mechanics of the jobs report is only useful if you translate it into specific market implication. A strong stronger than expected jobs report typically strengthens the dollar because it signals the Fed can keep rates higher for longer. It pushes bond yields higher as the market prices in reduced probability of near-term rate cuts can weigh on equities, particularly high multiple technology stocks that are sensitive to discount rates, and can pressure gold and other safe havens, which are less attractive when risk assets and dollar yields are rising. A weaker than expected jobs report typically weakens the dollar as rate cuts expectations are pulled forward. It pushes bond prices up and yields down. It supports equities, particularly rate-sensitive growth stocks, and supports gold and other safe havens. The most interesting scenarios are when the jobs number conflicts with average hourly earnings. A weak headline number combined with strong wage growth puts the Fed in a difficult position. See, the labor market is softening, suggesting cuts may be warranted, but wage inflation is rising, suggesting caution. These mixed signals produce the most volatile and unpredictable market positions. The non-farm payrolls report is not just a piece of economic data, it is the clearest, most timely available measure of the health of the world's largest economy. And because it directly influences the Federal Reserve's decisions, it moves financial markets globally every single month. Mark the first Friday of every month on your trading calendar. Know the consensus estimate going in. Watch not just the headline, but the average hourly earnings, the sector breakdown, and the revision to the prior month, and resist the urge to react to the first print without waiting for the initial spike to settle. The traders who read the jobs report correctly, not just the number, but what it means for the Fed and for each specific asset class, have a genuine, repeatable edge every single month. What aspect of economic data releases would you like us to go deeper on? Please let us know in the comments below. I'll see you in the next video.